Welcome back. My name is Atisha Paramasivam. I'm the Senior Wealth Advisor at Gold Tree Wealth Advisory. We're a financial planning business based here in Melbourne. Last week I spoke to you about offset accounts and how they're beneficial, how you can use it. Today I'm going to show you how 3 things come together to hopefully help you reduce your interest repayments over the years. So we've got my props here again. I have my offset account and the loan that you're about to pay off. I've got some cash here, which is handy, and I've got a fake credit card. It's just my rewards card that I'm using as a credit card. So again, we've got the same scenario. We have a loan that we have to pay back of $100,000 and we've got some cash. So you and your partner again have thrown in some funds into your offset. Let's just assume it's about $10,000 worth of funds that is sitting there. So typically what we would normally do is we have our salary come in, then we obviously go off and we pay for our groceries, our petrols, everything else. What ultimately ends up happening is if we're taking funds out, we're reducing the amount of funds sitting in our offset. Even though $10,000 of salary had hit our offset account, we ultimately end up having maybe only $6,000 left over after we paid our groceries. So our interest is calculated on $100,000 less $6,000 sitting in our offset, so we're calculated on $94,000. But wouldn't it be great if we had more sitting in there? So our repayments are calculated on now $90,000 again, as opposed to $94,000. So how do we get to that? If you're someone who's great with your money, you're good at budgeting, and you're very controlled in how you use a credit card, this little strategy will help you reduce your interest repayments within a year. So the idea is all those groceries, all those petrol costs are going to be put onto this credit card. So we're building up all those expenses onto the credit card, so $4,000 worth of expenses. We're leaving all that cash, all that salary income in our offset. And then we allow the banks to calculate your repayment for the month. They withdraw your repayment. And then the day after and before the interest-free period on your credit card is over, we then quickly take that $4,000 and plonk it onto our credit card and pay off the full balance in full. Why do you do this? Again, it's to keep as much funds in your offset as possible to reduce your interest repayments over the years. But there is a pitfall to this. If you're someone who's not good at controlling how much you spend, and if you're unable to wipe off that credit card in full, or what you end up accumulating on this credit card ends up being more than your funds in offset, then you have an issue there. You end up paying more in interest than actually saving. But the other way around that is to actually put a cap. So your limit on your credit card should be pretty much somewhere equivalent to what you're spending per month on your standard groceries and whatever it is. So you can put a limit of $4,000 on your credit card to prevent you from going over. Anyway guys, if you do this over the years, you save so much money and hopefully save a lot of funds in offset for an emergency scenario. Thank you guys so much for watching. Please subscribe if you haven't already, and until next time, I'll see you again. Bye!